Welcome to The Explainer. Today we're going to tackle a huge question. In a world full of giant global companies, how can any of us really trust that the financial numbers they report are accurate? I mean, just think about it for a second. Try to imagine verifying the finances of a corporation with offices and factories everywhere, from Hong Kong to Houston. Each place has its own culture, its own currency, its own regulations. It's a massive challenge. How do you make sure an audit in one country means the exact same thing as an audit in another? Well, to solve this puzzle, the auditing world relies on this really powerful idea: a single, globally consistent methodology. It's like a master blueprint for trust, making sure that no matter where an audit happens, it follows the same rigorous plan. Okay, let's get into how this actually works. So here's the plan. We'll start by unpacking what this blueprint is. Then we'll see how it cleverly balances global rules with local needs. After that, we're going to walk through the 4 key steps of the audit itself, and then zoom in on the most critical concept of all, materiality. And finally, we'll see why this whole system is really the bedrock of our global economy. Alright, first up, what exactly is this blueprint? We're actually using a real internal document, the Global Focus Audit Manual, as our guide here. You can think of it as the single source of truth for literally thousands of auditors around the world. So what's its main job? Well, its core purpose, and this is taken right from the manual, is to create one single, high-quality way of doing an audit that works absolutely everywhere. This makes sure that an audit in one country meets the exact same tough standards as an audit on the other side of the planet. It's all about creating a common language of quality. Now, here's where it gets interesting. A global blueprint like this can't just be totally rigid, right? It has to be able to adapt to local situations without, falling apart. It's a real balancing act. And the way the manual handles this is pretty brilliant. The core methodology and the big international requirements, they are completely locked down. They're non-negotiable. But local firms are allowed to add specific rules for their own country's accounting standards. They can even tweak the terminology to fit the local language, like using balance sheet instead of the more formal statement of financial position. So, the bottom line is that the structural integrity of the whole blueprint is protected. This quote from the manual says it all. You absolutely cannot change the core substance. It's kind of like a skyscraper blueprint. You can allow different architects to account for local building codes, for sure, but the fundamental engineering principles that keep the building from falling over, those are untouchable. Okay, let's move on and see how this blueprint actually guides the audit process from start to finish. The real manual is hundreds of pages long, but we've boiled it all down into 4 key steps that every single audit has to follow. It all kicks off with step 1, preliminary activities. This is basically the should we even take on this client phase. They have to make sure they're independent and can actually get the information they need to do the job right. Once they're in, it's on to step 2, risk assessment and planning. This is where the auditors become detectives. They dig deep to understand the client's business, its industry, and its weak spots to figure out where the financial risks might be hiding. Step 3 is where the rubber meets the road, responding to risk. This is where the team performs all their tests, focusing on those high-risk areas they just identified. And finally, in step 4, evaluation and reporting, they pull all the evidence together, look at their findings, and issue that official audit report, the final verdict that investors and the markets depend on. And now we come to it, the single most important idea in any audit. It's the concept that makes this whole thing efficient and, frankly, even possible. It's called materiality. You probably have this mental image of auditors hunched over in a back room checking every single receipt, every single invoice. But for a global giant with millions of transactions, that would be completely impossible, not to mention a huge waste of time. The reality? They don't do that, and they're not even supposed to. They operate on this powerful principle called materiality, which works like a filter, letting them focus all their energy only on the things that truly matter. So here's the formal definition, right from the official standards. But let's break that down. In simple terms, an error or piece of missing information is material if it's big enough to actually change the mind of an investor thinking about buying stock, or a bank deciding whether or not to give out a loan. It's all about the size of the impact. And this isn't just some vague gut feeling either. It's all calculated using established benchmarks from the audit manual. So, for a typical company that's focused on profits, maybe an error equal to 5% of its profit is material. But for, say, a huge real estate company with tons of buildings, maybe 1% of its total assets is the key number. It all depends on what the people reading the financial statements care about the most.
Okay, but that leads to a fair question, right? What happens if there are dozens of these immaterial errors? $100,000 error might not be a big deal on its own, but what if there are 50 of them? Couldn't they all add up to become a huge problem?
And that is a fantastic question. Auditors have a really smart answer for it, and it's called performance materiality. It's basically a lower, more conservative threshold. Think of it as a safety buffer that auditors use for all their day-to-day testing. It's specifically designed to catch these smaller errors before they can pile up and cause a material problem.
And this shows you exactly how it works. If overall materiality is the absolute red line that you just cannot cross, then performance materiality is the much more cautious everyday working limit the audit team uses. It gives them this crucial margin of safety, making sure that even if a few small errors slip through undetected, the final numbers are still trustworthy.
So, let's pull all this together. We've talked about this complex, rule-based system, but why is it so incredibly important for all of us? Well, this blueprint is what ensures an audit provides the same level of assurance in New York as it does in New Delhi. It creates a process that is reliable, efficient, and focused on risk. And all of this gives investors, lenders, and regulators the credibility and confidence they need. It really is the foundation of trust that allows global business to happen at all. Ultimately, as the manual itself points out, it's a structured partnership. It's built on everyone understanding their roles, their responsibilities, and the rules of the game. All of it designed to produce one thing: a trustworthy, independent opinion that people can actually rely on. So, if you take one thing away from this, it should be this. A modern, high-quality audit isn't just about checking the books. It is a sophisticated, risk-based investigation, guided by this elegant global blueprint that is engineered from the ground up to do one thing: build trust. And that, of course, leaves us with the big challenge for the future. As technology like AI and new, decentralized businesses keep emerging, this blueprint has to constantly adapt. The question isn't if we need a blueprint for trust, but how it's going to evolve to support the global economy of tomorrow.